But literally, I need to put it on.
Gosh, it really does. Does everybody hear that? The bing bong noise? We've got Katie and Molly here from our tech and marketing team supporting us today as well, who'll be busy opening the door, letting everybody in. And look, I think we should get going. It's 12:01. We've got lots to go through today. So kia ora, tēnā koutou katoa. Ko Tonkin and Taylor ka mahi aho, ko Simon Harvey toku ingoa. Welcome, Simon Harvey here. We're delighted to host you to another action-packed session with some of Aotearoa's leading experts today, covering climate-related disclosures in the context of metrics, targets, and assurance. We're going to ground the session just to kick off with a karakia. So, whakataka te hau ki te uru, whakataka te hau ki te tonga. Kia mā kina kina ki uta, kia mā taratara ki tai. E hi ake ana te atākura, he tio, he huka, he ho hu, ti he mauri ora. Let the winds blow from the west, let the winds blow from the south. Let the breeze flow over the land, let the breeze flow over the ocean. Let the red-tipped dawn come with a sharpened air, a touch of frost, a promise of a glorious day. Behold, there is life. So welcome everybody. Today's session is on metrics, targets and assurance for climate-related disclosures. It's a big topic, so we've selected what we think are the most useful aspects to start with, and at the end we'll come back to you with a question to see if there's other things that you want to cover. We're going to hear today from Marta Karlik-Neale, who share her experience about clarifying terminology and concepts associated with metrics and targets in the climate-related disclosures context, as well as reviewing and discussing current disclosure practices and some of the lessons that have been learned by organisations. Then we'll hear from James Hughes. He's going to talk about climate risk metrics and targets, specifically aspects of vulnerability, exposure and risk. And then finally, we're lucky enough to have with us today Jeska McHugh from McHugh Shaw. And Jeska will provide a thorough overview of assurance practices and what auditors are looking for. It's going to be really valuable. I'm looking forward to hearing about that. So throughout the session, please, everybody, do use the chat function. You can do that to share comments or thoughts, observations, but really importantly, please put your questions in the chat because we'll want to come to those. Each section, we've got 4 sort of mini presentations and each one will be followed by an opportunity for some questions and discussion. So please put your questions in as we go along. And just to start with, we're going to ask you a couple of poll questions, and that will help our presenters today understand a little bit more about you, which will enable them just to tailor the content a little bit. So Katie is going to share the poll in the chat. So if you get your chat function open on the sidebar of your screen, and you'll see there will be 2 polls there. The first one asking about your level of experience. So please just select the level of experience that you think is appropriate for you, and then secondly, your role with respect to metrics and targets. So you are a report reader, a writer, a manager, a consultant, or an auditor. So please put your votes in now, and we'll just give you 30 seconds or so, and let's see who we've got in the room. Let's see, here we go. So, yeah. Well,
a lot of writers.
Fairly confident and understanding the basics, a few beginners. Good mix there. And in the second category, we got readers and writers, some managers, a few consultants, a couple of auditors. Excellent. 44 responses, that's 50% vote rate. I'm sure we can do a little bit better than that. Just 2 clicks of the mouse. That's given us a pretty good indication. So we'll take that into account. there's a bit of a spread there. And as I say, we'll come back at the end. We've got another 2 questions that we'll perhaps find out if there are other things that you want to hear about. But let's get cracking. I'm going to hand over now to Marta Karlik-Neale from Tonkin Taylor, based in our Nelson office. And Marta's going to set the scene for us and then dive into the topic of greenhouse gas metrics. Over to you, Marta.
Thank you, Simon. So we're going to be focusing on metrics and targets, which is the last part of the XRB standard, and it covers the disclosures from section 20 to 26. That's probably the most dense part of the XRB standard, so we're not going to be able to cover all of it. We've recently done a bit of a review of the climate reports that came out this year and looked for the areas which people found a bit more challenging. So we focus on those. Those are the things around greenhouse gas emissions, also transition risks and assets. So before we delve into details, I just wanted us to reflect a little bit on the purpose of metrics and targets. And if you look at what the standard says, it's clear that it focuses on the readers of the reports and their ability to understand what the organizations do in terms of the carbon credits, and also the ability to compare from one organization to another. However, that is not all that we, as the writers of those reports and the managers of greenhouse gases within the organization, or managers of climate within the organization, have to think about. More important is our business decisions and whether those metrics and targets are supporting us in making those decisions. So are they telling us whether we're going in the right direction? Are they telling us whether we are moving fast enough, whether we're progressing? Are they telling us about our value chain and what are our hotspots, and whether we can understand what's happening there meaningfully? And finally, are they telling us our full story? Are there any things that those metrics are hiding, whether positive or negative? And then once we're confident that our metrics and targets are answering the right questions, we should also be looking into the design of those metrics, whether they're clear and understandable, reliable, and consistent over time. So let's go into it. As I said, we decided to walk the middle path and try to be informative, but also cover the basics to an extent. So the 3 areas that really stood out as most challenging last year was still a fair confusion around the terms and which of those to use, boundary setting, and also assessment of uncertainty. So I'll cover all 3 of those now, one after another. I've put together this slide to help talk about the terms. So the standard calls for gross emissions, and that are probably the simplest metric, just a simple addition of all your scope 1, 2, and 3. However, the standard also asks us to talk about use a location-based method for estimating those gross emissions, which means that we're using the average New Zealand stand factor for the electricity, the MFE factors. I will suspect that a lot of you here on the call are starting to purchase renewable energy certificates. If you're doing that and you want to include that in your reporting, you then assigning your electricity factor will be 0 for the electricity where you're buying renewable energy certificates. For the rest, you're going to be using residual emission factor, which is in New Zealand provided by Brave Trace. If you're doing that, then your gross emissions now market-based. If you're also buying offsets or planting trees on your land, then, and you want to account for that in your metrics, then you'll be reporting in net emissions. And all of those are still absolute emissions. If you divide them by revenue or some other output metric, for example, amount of product produced in a year, then you'll get to the intensity. So let me show you what different organizations have done. to, on one hand, account for the fact that the standard requires only gross location emissions, but they're not telling the full story. So having a look at the warehouse group, they decided to also report on market-based emission. And I assume that's because they're purchasing renewable energy certificates, and they wouldn't be able to tell the full story otherwise. Comvita, another example here for you, decides to report on net emissions as well. And that's because for them, they have Manuka forests in which for which they try to claim carbon sequestration. They're also part of the ETS scheme, so they want to report on that. And even further, there is that biofuel combustion, and the organizations that report that use biofuels, their carbon emissions from that are actually included outside of gross emissions in your net. So again, to tell the full story, for those metrics to be meaningful, sometimes you need to go a little bit beyond what the standard requires. I know that's just scratching the surface of all of those terms. We will have some time in the questions time to cover a little bit more if people are interested. I'll move on to the next one, though, which is the next big challenge, which is the boundary setting. So boundary in greenhouse gas accounting refers to the process of deciding which business units and which activities and emission sources are included in our inventory. They are sometimes, that concept of boundary is sometimes confused with the scope. And scope is something completely different, while in lay language, it does mean almost the same as boundary. Here, it refers to the classification of the emissions. It allows us to know which of those are direct emissions, where we have a lot of control, and which ones are indirect emissions, and our wider value chain. The ISO standard and Scope 3 greenhouse gas protocol provide us with a list of what should be included in our boundary, with that minimum boundary. And sometimes it's quite extensive, as on this example here for purchased goods and services. And that's why the Scope 3 is such a challenging area, and it has been for quite a while. But I wanted to show you another statement from Scope 3 standard, which organizations often forget about. The standard actually says that you do not need to account for all of your value chain emissions, and that it is an organization's choice to decide which ones of those Scope 3 activities are included, as long as you are reporting on the exclusions and on the justifications. So that's something sometimes forgotten and worth keeping in mind. So how do we choose which of those emissions we include? So there is the little process chart here on the slide we developed with a couple of organizations we worked with. And the way we do that is we first of all create a list of all of the emission sources that organization has in its value chain, using those minimum boundaries, but also looking at the wider, what's happening within our organizations, and coming up with lists of the unique emission factors or emission sources, and then also identifying which ones are actually not applicable, which activities we don't have in our value chain. And then comes the materiality assessment. This is how we decide which of those emission sources we're going to include. The list of the criteria that I've got on this slide comes from Science-Based Targets Institute, apart from that last one, ability to measure. And I'll talk about that a little bit in a moment, because that's the interesting one. The last part of the process, obviously what I've already said earlier, is the disclosure. So I found it really surprising that Science-Based Targets Institute did not include the ability to measure in that criteria, because in other parts of the guidance that they provided, they do acknowledge that Scope 3 is a continuous improvement process. They even acknowledge that GHG metrics might not be the best suited to actually measuring progress in climate action and value chain. So while all of that is happening, we find that the actual practice is that ability to measure becomes quite an important criteria to keep those targets meaningful and useful for us internally. And XRB gives us a bit of an opening with those industry metrics and KPIs that we can use. So let's have a look at a few examples again. Warehouse, where everybody gets the bargain. Obviously, the purchased goods and services will be the largest source of the emissions in the value chain. However, in the last climate report, they have completely excluded it. And they've excluded it based on the not having an ability to reliably calculate those emissions. But what I find really interesting and what makes this more transparent and I think acceptable for the readers is that justification is much more extensive than just saying we can't measure it. They actually talk about the 40% of suppliers that they provided training for. They talk about 65 suppliers that they provided with the GHG measurement tool. So these start to explore those other metrics of how can we measure the progress in supply chain and in Scope 3 emissions. Z Energy is also interesting. You can see that there is a range of justification for the exclusions. Data availability, again, not being able to measure is one of them, but also acknowledging that continuous improvement around employee commuting. They say that they acknowledge that previously they thought it wasn't material, it wasn't large, but they actually think they do need to assess it, even though they don't do it this year yet. And then obviously, for example, for downstream leased assets, they deem those emissions immaterial, so size is the criteria they use here. That energy is also interesting because they use those other metrics or other KPIs that XRB mentions. And in their case, they relate to the highest source of emissions, which is obviously the combustion of the fuels that they sell. And that's their efforts around promoting EVs and their efforts, the partnerships they have got with companies developing low carbon transport technologies. So interesting, and I think worth keeping in mind when you're struggling with Scope 3. So the last topic before we go into questions is uncertainty, and that turned out to be quite a bit of a headache last year. Jeska will talk about this a little bit more when she reflects on the assurance last year, but I wanted to show you how we have approached it this year. So those of you who are writers of the report or measure greenhouse gases in their day job will be familiar with the Ministry for the Environment guidance, and you will know that some of the emission factors that come with the assessment of uncertainty. But that's not all that we are asked to report on by XRB. The other sources of the uncertainty come from the choice of calculation methodology. So obviously when you use primary method, something like the liters of fuel that you're combusting in your assets, the uncertainty there is very low. But if you start using secondary methods like national statistics about how employees commute, that has got much higher uncertainty. So what we have developed, and I'd love to hear your feedback when we have questions and comments, is this little framework that organizations can use to disclose the level of uncertainty in their emissions. And that basically just looks into the uncertainty in calculation methods and data quality, like that. The final things before we move on, I just wanted to show you Comvita's disclosure again, because I find it really, really good and very useful. For their purchased goods and services, they try to estimate the full scope of the supply chain there, but they have reported on how they measured it. And obviously they've done it differently for different parts of the different suppliers. And so 2% is supplier specific. So we know that the uncertainty there is very low. That's very reliable data, but 66% is spend based. And that is a really, I think, a good example. I recommend we do more of that. All right, that was all for that section. Simon, can I pass on to you to moderate the questions?
Yes, thank you, Marta. That isn't going to be too hard. At the moment, we've got one from Wymond, and so that has been got a few thumbs up. I'm just going to invite you, Wymond, if you're able to talk. Would you like to ask the question yourself? Just unmute yourself. I think you're allowed to do that.
Okay. Yep. Thanks, Simon. I suspect this question can be answered by one of your other speakers, and so I might be jumping ahead a little bit, because this is probably something that gets picked up at an assurance level. But just getting some clarification across, I guess, consultants in the room and also our one auditor that's in the room who's going to be talking later about offsets and how we treat those in terms of the reported or disclosed footprint, whether they can be subtracted from your gross footprint measurement as part of your net footprint calculation, or whether they have to be reported separately.
Simon, Marta.
Yeah, I'm wondering whether I should go back to that original slide. So when you report, what the standard calls for is gross emissions. So no offsets, no renewable energy certificates. But the standard doesn't tell you that you cannot disclose further information. So, yes. And what you will see later, I've got a couple of examples to show, is that you can you report your gross emissions, but then in addition, you then report your net emissions and what are those removals in there, whether they are planting or whether they are carbon credits that you're purchasing. Does that answer your question?
It does. I have heard from others that you can remove your plantings or your removals in your net calculation, but your offsets cannot be subtracted. They just get reported separately.
Depends. There's a lot of different standards. So SBTI, when you're calculating your targets, accepts certain types of offsets, but doesn't accept others. Jeska, do you want to comment on that further?
I can do it. It depends on the standard. Obviously, the climate standards don't require reporting of net emissions, and so there's less emphasis on that. A lot of the audits I do are to the ISO standard, and there's nowhere in the ISO standard that says that you should deduct offsets from your net emissions. It's very clear that you can deduct your scope 1 removals. Just from an insurance provider point of view, it's very hard for us. Well, it's not hard for us, it's time consuming and often outside of the scope of our engagement to assess the credibility of those offsets. And that's something that you've got to be really careful of, as well as claiming something that isn't credible. So it, yeah, absolutely is a grey area and standard dependent.
Thanks, Jeska. Marta, thank you for that. Let's have a look with another question here as well from Alexandra, who was our first guest today. We saw you waiting in the lobby there, so thanks for your patience, Alexandra. Would you like to ask your question?
Sorry, I'm probably one of the most ignorant people here. I just wondered if the regulation demands that companies indicate whether their exclusions by category or proportion of budget is increasing or decreasing.
The regulation requires you, there are provisions around the statements around changes to methodology in comparison with the base year. So if you're excluding something, you're changing your boundary. If you're excluding something new in the year, then you changing the boundary, therefore you need to recalculate your base year so that your comparisons, you're comparing apples with apples. But you don't need to be showing whether the area, the emissions that you are excluded, whether that area is growing or staying the same.
Thank you. Perfect answer. I understand it. Also, if you don't disclose your input, say that example from India, do you assume that that was entirely fossil fuel and had to buy a certificate accordingly, or is it assumed there were no emissions?
So let me try to understand. So your input from India is a product that you're sourcing from India, and is that correct?
I don't know. It was just an earlier example saying one of the warehouse, I think, said we're excluding this from our reporting because it's from India. So would they be obliged to, do we assume it was fossil fuels and there was emissions, or assume nothing?
We can assume nothing. They're just saying we have a supplier in India that provides us with a product, and there are associated emissions with it. They probably are fossil fuels to an extent, and they say we cannot measure what it is at the moment, so we're not reporting it, but we acknowledge it's large, and therefore we work with them to give them training on sustainability and training on how to start measuring it.
Okay, and is it New Zealand or India that would pay for the emissions in the carbon trading in the end?
So this is not related to carbon trading.
Not related. Okay,
No,
thank you.
No.
Thank you, Marta. Thanks, Alexandra. And we've had a clarification as well, further comment from Hannah. So thank you for that, Hannah, in the chat. Adding to the question about offsets, that's bearing in mind the legal risk associated with misleading statements. So if you're talking about a net number, be clear about what it means and what you've taking into account what a reasonable reader would think it would mean. And we know that there is. Is there anything to add to that, Marta?
Yeah, so something to keep in mind, kind of following on what Hannah said, is there's this principle of fair presentation in CS3, and that relates to that kind of provides the setting to the fact that we can't just provide a number. We need to actually provide all of the explanation, and unfortunately, in terms of the disclosure, more is better because it gives that more fair presentation. Would you agree, Jeska? Yeah,
absolutely.
Great. Thank you. Thank you for that. Look, great session. And if we do have any more questions, just keep putting them into the chat if anything comes to mind. We try and answer those after the session. So thank you, Marta. That's a great kickoff. We're going to hand over to James now, who's going to talk about climate risk metrics and particularly what are the required disclosures, how to assess risk and develop metrics, and then he's going to offer some examples for us to think about. So James, over to you.
Thanks, Simon. Kia ora tātou. Marta's going to drive for me, so I'll just sing out Marta when to go to the next slide or click through. So just to clarify what I'm going to talk about, I'm just going to focus on the green boxes there, which is physical and transition risk metrics, which many of you will know. It asks to look at the percentage of assets or activities vulnerable to physical or transition risk. And I want to start with this word vulnerable, which is confusing a lot of people, including myself. I'm not going to talk about the other metrics and the disclosure elements because we won't have time for that. But if there are questions or comments, perhaps we can dive into those if needed. Just to start off, some considerations here. First up, when we're thinking about metrics in general, and particularly physical or transition ones, we need to think about the types of measurements that we're using, whether that's direct or proxy indicators, or whether they come from financial metrics or management processes. There's going to be a range of those, and they're going to be bespoke for each metric that you might want to consider and for each organization as well. Secondly is the methodologies and the definitions and the scope of those and the data sources of definitions. Again, this concept of vulnerable that's used, which I think vulnerability is probably the worst word to define that exists in the landscape of risk language. It's very confusing. So the methodologies and definitions is important. And I guess a sub point here is, and I'll talk a bit more about this, whether we're developing a metric based on assessment of current state, i.e. vulnerability or exposure, or some assessment of historical trends. And the trends also apply, as Marta has said, to making sure that those metrics that you do develop are presented over time so you can compare current year with what's happened previously. Next slide, please. So diving into this concept of definitions, I've used the IPCC because I think that's probably the best framing for the definitions that are most used in the climate space. Vulnerability is defined as the propensity or predisposition to be adversely affected. It encompasses a variety of concepts, including sensitivity or susceptibility to harm, and or the lack of capacity or the adaptive capacity. So vulnerability is an inherent function of a system or an asset or a facility or something that we're considering. That's vulnerability. Exposure is the presence of people or livelihoods or infrastructure or an asset in a place that could be adversely affected. Is your building in a floodplain? It's exposed. Quite a useful measure and quite straightforward. Risk, however, and this is the middle of the diagram on the left, and as defined by IPCC, is defined as the potential for adverse consequences, so the chance of something bad happening, effectively. And you can assess risk through the combination of exposure and vulnerability. Exposure to a hazard and the vulnerability that exists, depending on what the risk element is. So if we take that view of risk from the IPCC, and which I sort of lean on, then there's I guess a question. You could choose a metric based on either exposure, vulnerability, or risk, but you need to probably be careful how you're defining those. Next slide, and I'll just dive into this a bit more. There is no published definition of vulnerability in any of the standards. In fact, I've looked throughout the IFRS, I've looked internationally. So the word percentage vulnerability, I think we've got to define it how we want to and take a pragmatic approach. So therefore, and they'll be nuanced, but I think you could choose, and this is what we advise, to either assess exposure or vulnerability, or in fact, you might want to assess risk, but being very clear on what you're assessing is important and taking a pragmatic approach to the assessment of that. Then the last point here is a slightly different way to consider a metric is based on some historical trend, which might be backwards looking in terms of, and I'll come to this, is the occurrence of a particular event in the physical sense, for example, a flood event or a damage event or something that you might record over time. That's a different type of metric, but you could say we've had this many buildings damaged or the occurrence of this type of event. So that's, in my opinion, a slightly different category of metric. Next slide, please. So just to look at some examples of how we might measure, and I'm just focusing here really on the physical risks at the moment. If you were saying we're going to assess exposure only, we would gather hazard information, flood data, and we would undertake an exposure assessment, and our output or our metric might be the number or percentage of assets within that floodplain. That's very easy to do if you've got the data, and I think a very useful metric. If you click down, if you want to look at vulnerability, as per the IPCC definition, you might gather information on the age or the material or your condition of your buildings or your assets. And you could report on the number or percentage of assets within, for example, different vulnerability categories. Now, I'd note here that vulnerability categories are publicly available in relation to physical risks particularly, and in relation to different hazards. They are called damage functions or vulnerability functions, and you might have a different vulnerability factor, for example, for a timber building as opposed to a concrete building or a multi-story building, if you're a property developer, etc. So there are easily accessible data sets for vulnerability. And lastly, if you just click once more, thanks, is the risk. Again, you could choose, if you like, to report on risk, which is the combination of those exposure and vulnerability data. And so you might say the number or percentage of assets at risk. And again, defining what we mean by at risk and how people might read that is important, but you would integrate your exposure and your vulnerability factors. Hope that makes sense. I know it's slightly confusing, but we need to take a pragmatic approach to this. And I think each organisation should just choose a metric and then be consistent with how they're doing it. So now just I'd like to walk through a few examples, and I'll just get you to click through these as we go, Marta. There's about 6 of them. So the first one, from a physical risk perspective, you might choose to develop a metric around exposure to extreme weather events. That could be the percentage or value of assets in areas exposed to physical risk. So that's again, exposure assessment there, or the proportion of revenue attached to those. You might look at metrics around supply chain vulnerability. For example, the percentage of suppliers in certain regions that could be exposed to those physical risks, or the number of disruptions or delays caused by climate events over a specific period. So here's an example of a historical backward-looking metric that you might record over time. Water and resource stress metrics. So water obviously being a key factor influenced by climate, and if you've got a high reliance on water, you could report on the volume of water used per unit of production, or the proportion of facilities exposed to water-stressed areas. There's some operational resilience metrics, for example, that you could look at the number of operational days lost due to climate-related events. Again, a backward-looking trend that you could report on, or looking forward, the amount invested in climate resilience, for example, flood defences or energy efficiency upgrades in a transition sense. Insurance and recovery metrics, it's an interesting one. The ratio of losses that are covered by insurance versus uninsured, that would be an interesting metric. And again, here's one around recovery time. That's again backward looking, time taken to recover from extreme events if you're exposed to multiple of those. And lastly, some here around temperature and heat stress. So for the percentage of workforce operating in high temperature environments, or cooling related energy costs that might change over time. These would be, again, tracking that both backward looking and into the future as well. So those are some examples of metrics that you could use. I've got a very brief example here. Marta, if you could just click through a couple more times. This is from a disclosure from an aged care company, Oceania. You can see on the right there, they've disclosed their assets exposed to coastal inundation, coastal erosion, and river and surface flooding. And they've said on the top right, 2 sites are potentially exposed to coastal inundation, which represents 3% of their portfolio. And down the bottom, in river and surface flooding, they've got 10 sites potentially exposed, which represent 24% of their portfolio. And they've said there, you don't have to read it, but they've gone into quite a lot of detail on the basis for that assessment, what data sources they've used, etc. So now, just a couple of examples on the transition risk side, and we'll just step through some examples here. So I think the same applies. You're going to have different types of assessment that are going to relate to different measurement areas, both current state, but also potentially trend and backward looking as well. So first up is capital expenditure, or CapEx or OpEx, related to carbon. So low carbon CapEx, the proportion of CapEx allocated to renewable energy, energy efficiency, or other technologies, or high carbon CapEx, the spending on fossil fuel related projects which have potential to become stranded in the future. Revenue from carbon intensive activities. So the proportion of revenue derived from carbon intensive activities. This is an interesting one, like coal, oil, or gas. This is particularly related to, say, the finance sector. Or the second one, revenue from green products. So income or sustainable or climate friendly products if you're operating in those sectors. If you're again in the finance sector or investment, the proportion of your portfolio aligned with high carbon assets. So this might measure the percentage of a company's or total assets invested in carbon intensive sectors like coal, oil, and gas. Financed emissions, quite a common one we hear about. Again, more for the finance sector, but the total greenhouse gas emissions resulting from investments in certain sectors, including the indirect or financed emissions by loans or equity stakes. Sectoral exposure might look at sectors of that you might invest in, whether that's oil and gas, agriculture, petrochemicals, etc. So again, that might help in a bank's context, its vulnerability or exposure to transition. And lastly, around energy transition, so the energy mix, the proportion of energy sourced from renewables versus fossil fuels, or the energy intensity per unit of production. That's more relating to some of those metrics that Marta was talking to as well earlier. So I've got one example here, which if you click through once more, thanks Marta, that'd be great. So this is just focusing on that example of loans or balance sheets relating to oil and gas. And this example shows the on-balance sheet loans and advances for 6 categories: coal-fired power, coal mining, oil and gas sectors, etc., off balance sheet and the total, and then presented as a percentage exposure. So that's just an example there of how that could be captured, and again, more related to companies that have investments in those sectors. There's a quick race through there. Yeah.
Yeah, awesome. Thank you. Lots of information. And then we've got a few questions that have come through here. We've got 3 questions here. We've just got 5 minutes for the questions here. So let's see if we can rip through these. Wyman up there first again. Wyman, do you want to quickly ask your question?
Yeah, Simon, and then I'll stop asking questions.
It's all right, Wyman.
Yeah. How do you define a climate event? So, the standard requires you each year to disclose, the financial and other impact of climate change events that you've experienced in the current reporting period. I think a lot of people are struggling with the definition. What do you consider a climate change event as opposed to what you might anticipate as a regular storm or some other more regular event?
Wyman. James.
Yeah, great question. I don't think I'm probably want to go into climate attribution and the complexities of that. My take, Wyman, on this would be the idea is to disclose the material impacts on your organization from events. So if you were seeing damage from a flood, I would be agnostic to whether it might be climate exacerbated or not. If you've had ongoing losses over years from flooding, that is what you're disclosing, or tropical cyclones or extreme weather, whatever it might be. I don't think the standard or the intent is to try and differentiate what the attribution or the increment that might be caused by climate is on that. I think it would be just disclosing the business's impact from those events that have climatic drivers associated with them. Does that make sense?
Yeah, it does. Yeah, great. Thanks, James.
Thank you, James. And then we've got Maria has asked a question, which I think I can just chuck to you quickly. This one, do you got an example of a service sector for what you've been presenting there, James?
I don't off the top of my head. Help me out with an example. Can we be specific?
Well, Maria, do you want to? Maria, what are you thinking about specifically?
Thanks, Simon. I can just chip in. I'm thinking of companies that may have, I'm in the education sector, so university, for example. We have a large property portfolio, but our main activity is education providing, right? So I was just wondering, because that you presented a really good slide on, I think it was the gas and oil industry example. Yeah, I think that was really helpful, and I was wondering whether you had anything in the service sector or even the developers. Yeah.
I think you could go back and, I mean, I'm just thinking off the top of my head here, Maria, but thinking about what types of impacts could manifest, and I guess for that would be material for the education sector relating to climate. And I think looking at those risks or impacts and then thinking what metrics might be able to relate to those. And if one was, for example, I don't know, extreme events in the physical sense, meaning that attendance drops or income drops, then you could sort of relate metrics to that potentially. Whether there's, I think it's about understanding the vectors, the impact vectors that lead to material risks for your sector, and then aligning the metrics that associate with those. That would be how I would go about it. So whether it's related to attendance, whether it's related to buildings not being functional in an extreme event so people can't attend, that would be, for example, of the exposure of buildings, whether it be outages of critical services. I think it's finding out what those core risks are and then seeing if there are some data, direct or indirect data proxies that you could measure over time. That's how I would approach it.
Yeah. We should use our sector scenarios. I was just hoping for specific metrics. It's great. Thank you. That's really helpful.
No James, and I just sent James an article today. Actually, I see that there's been a Green Gown Award for the work of the tertiary sector in developing their climate scenarios, which is quite cool.
Yeah.
There's an article on that today. So that's
yeah, we're very proud of our work. Yep. Really well.
That's great.
Thank you, Maria. We've got time for one more question here. And this is a tricky one, I think, from Alexandra. And I think is one of the big questions in the local government sector. Maybe, Alexandra, if I could try and summarize it. But no, look, you ask it, because I don't want to get it wrong. Alexandra, would you like to just quickly ask that question?
Yeah. Could Council's looking at its shoreline adaptation strategy and deciding which areas should be hold the line. Can private companies hold council to protecting public assets because that's what they have relied upon to protect their private assets? Yeah, that's it.
This is a complex question, obviously. If you as a private organisation is disclosing, for example, that you are relying on certain policies or support from, say, council to shore up the resilience of your organisation over the long term. However, that support is uncertain because council could change its policy in the future, or the government hasn't established roles and responsibilities and funding mechanisms over the long term to allow adaptation. Then, as a reader of that, if that wasn't made explicit, you could ask questions. If you're asking whether there's any liability, I don't think there would be, because that's a separate consideration, I think, which probably needs another conversation. So a private company could disclose what it likes, I suppose, and say we are relying on council to continue to maintain the seawall where our factory is located, but that they could also disclose there's a risk that council could backtrack on that decision or change their mind. I'm not sure if I've answered your question.
It's a tricky one, isn't it?
Yeah, but it's it's definitely a valid point, a valid concern. No, it's very interesting. Yeah.
Thanks, James. And we did have one little addition here as well from Hannah about the university question there. Are you saying that you start with your risk table? So if you're a university, a risk might be a geopolitical instability, leads to lower attendance, and then you disclose a related metric to that. So, for example, the number of international students. Is that essentially what you were saying?
First of all, yeah, I think your metrics, if they are, and this kind of is a broader question. I think alignment between scenarios, risks, metrics, and targets, and ultimately the finance piece, which we're not talking about, that's next week, is important. So if you're aligning with your risks, your metrics, then I think that's really good practice. That makes sense. In terms of the example, you're talking about number of international students. Yeah, I'm not sure. It might be a proxy for that. Yes. But it's probably another discussion, but alignment, yes, I think it's really good practice.
Thank you. Thanks, James. We need to keep rolling. It's time. We've all been sitting down for nearly an hour, just over 45 minutes. So we need to follow good practice here and now just take an opportunity to stand up. We've got 1 minute just to have please do stand up. Listen, the presenters will lead by example. And stand up and have a stretch and just allow your body to get the blood flowing after sitting down for an hour. So if you've got some space, you can wave your arms around a little bit, or just put them up above, or just have a stretch before we get ready for some more meaty content. All right, thank you, James. That's good. All right.
I won't lead people through my yoga routine, don't worry.
Well, next time we'll allow a bit more time for that, James. I know they'll probably take a few minutes. And there's a question in there. You could maybe just tap an answer in that to the question there while we turn back over to Marta from Elizabeth. So Marta, we're going to hand back to you now, and you're going to give us a bit of an insight into greenhouse gas targets and target settings. So talking about the SBTI process, non-GHG metrics, how to present targets and progress, and in some case emissions reductions plans, and talk a little bit about some of the forgotten climate statement 3 requirements. So Marta, over to you.
Thank you. So back to talking about greenhouse gases for a bit. The targets in the XRB standard requirements, they relate to both GHG targets, but also those wider climate risk targets that are still a bit of an emerging area. And the way the metrics and targets and the reporting on progress is supposed to be designed is really defined quite in detail in the standard, especially in that CS3 section, which in the last, we've noticed last year, have been a little bit forgotten. There is quite a lot of additional requirements that come from this standard, especially around the methodologies and the specifics of how those targets need to be defined. But won't go too much into details about this, and again, we can look into that during the questions. What I wanted to focus on most is these 2 topics. One that we've already had a question on earlier, a little bit about reliance on offsets, and the other one linkages to aligning with 1.5 degree warming. So if I move on to that, this alignment of 1.5 degrees all relates to the question of how much should we be committing to. So what our target in terms of greenhouse gas reduction should be. And if you talk to your business will want to be careful and will ask you what is achievable. And the way you answer that question is through your transition plan. This is what we talked about in our last webinar. And you will want to define your emissions reduction plan and think about what sort of targets you think you can achieve. But your external stakeholders will probably be more interested to ask if you are doing your part. Are you aligned with what New Zealand has committed internationally? And the standard asks you for even more. It actually asks you to explain to the readers whether your targets are aligned with this global ambition of achieving 1.5 degrees warming. So let's start with the national targets first. So there is a lot of controversy around the targets. They come from our Carbon Zero Act. And if you looked in LinkedIn, there is a lot of comments about whether we're actually achieving 1.5, whether we are even achieving the targets that we have set ourselves. But as a business, it can be quite simple. So if you look at the 2030 targets, it's just 50% reductions from 2005 until 2030. And the long-term target 2050, it's net zero. That has changed. There's a little bit more complex if you're an organization that is in the primary industries and have got a lot of biogenic emissions like Fonterra, but we won't go into it for now. So let's look at the Science Based Targets Institute. This is where that global ambition of 1.5 comes from. This is the organization that sets the criteria for setting targets that are considered in line with that ambition. And that standard wants you to set two targets. One is long-term, latest by 2050, but could be earlier, and the short-term, near-term target, latest by 2030. And they're supposed to be counted against the base year that's before 2020. Now, in order to set the standards, Science Based Targets Institute can lead you through a process of setting this target and then validate it for you. But that's a very extensive and expensive process, and a lot of organizations tried and not got there. So a lot of organizations in New Zealand decide to follow the approach that was set by Climate Leaders Coalition, and that's to recognize that we don't have to necessarily go through this process of validating SBTI targets. Rather, we can use the criteria and just explain the method. So XRB allows you to do that. XRB does not call for validation of SBTI targets, but it asks you to explain methodology. How did you arrive at those targets? So last year, SBTI has just published a new set of criteria of how to set both the long-term and the short-term targets. And that's, I encourage you to delve into it if you are going to do it independently. But we have summarized it for you here, just those four bullet points, which most of you will know: the net zero, 90% from absolute gross reductions and 10% relying on offsets. The interesting part here about relying on offset is that what SBTI agrees for being included in that percent is the permanent carbon removal, which is planting trees on your land, and the bioenergy feedstock production carbon credits, which means that carbon credits that come from, for example, renewable energy projects wouldn't be counted in that net zero target. And then the last one that people sometimes forget about is that 100% renewable electricity. All right, if we look at the short-term criteria, the near-term criteria, there is two levels of ambitions. The SBTI wants us to set scope 1 and 2 emissions aligned with 1.5 degrees, while scope 3 below 2 degrees scenario. And again, with XRB, while it's not spelled out implicitly, because what the targets calls for is explanation of what you have done. So your scope 3 targets do not have to necessarily follow 1.5 trajectory. It's okay for them to go with the below 2 degrees as SBTI covers it. What's worth noting is that this target, and that's why often this target setting becomes difficult for organizations to validate with SBTI, is that SBTI will want you to have 95% of all of your scope 1 and 2 emissions included there, which often is achievable, but where organizations fall out is for the scope 3, where we want 67% of all of the emissions covered, which can be challenging. So the question that everybody wants to know is, so what is the percentage emissions reductions that I need to commit to in order to align with 1.5 degrees warming? And that is quite complex. I've tried to set it out here on this slide with an example, but basically it depends on what sector you're working in, and in which case there might be specific guidance. But even if there isn't any specific guidance, that will depend on what you choose as your base year. And if your base year is beyond 2020, that becomes even more complex calculations. I'm not sure if people want me to be explaining it right now, so I will leave it for questions and answers, and we can come back to it if that's of interest. But what I wanted to finish off is I just wanted to show you some example of the visuals that people are using in their reports. to show what their targets are, how they align with 1.5 and how they're progressing. And I found the airports actually most interesting this year. So let's look at Auckland. So as you can see, the red line, that's the 1.5 trajectory. You can see that in FY23, which is the date of this report, they achieved 27% reduction, which is below the target. They're doing well. And then the striped area, that's the emissions reduction plan, the projection. So what you can see here is that they're expecting the electricity to drop down. So they will be buying renewable energy certificates, most likely, unless they are planning to produce enough renewables themselves. If they're buying RECs, then that chart presents market-based emissions, and they would have to somehow also disclose their location-based emissions. It's always nice to compare the capital with Auckland. So let's have a look at what Wellington Airport has done. The Wellington Airport is not a climate reporting entity, so this is a voluntary disclosure. So they didn't actually talk about alignment with 1.5, but instead they've traced here the intensity projections, which I find very helpful. And again, they're showing what they're going to do with the emissions. And you can see that the plan is to phase out gas and its usage for heating at the airport, but also the reliance on diesel in the vehicles, electrification of the fleet. The light green is the electricity. So you can see that from FY24, they're going to be buying RECs again. And again, this is a market-based reporting, but it allows them to tell the full story. And finally, moving on to the provinces, I wanted to show you how Nelson Airport decided to tackle this. Again, they're not a reporting entity, so that's just voluntary disclosure, but they are trying to meet the XRB requirements. So they're showing both the gross emissions that are location-based and the market-based ones. And they are already achieving their net zero target. They're climate positive, but somewhere in their disclosure, if you read through it, 67% of those reductions are achieved through carbon offsets. So that's way over that 10% that SBI indicates. So they've got a long way to go from that perspective. That's all I was going to talk about for targets. So if there are any questions, we can delve into some more details now.
We have got one question through from Carol O'Sullivan, and we've only got a couple of minutes, so let's just pick that one up. Do you have any examples of how businesses have shown alignment with New Zealand's net zero targets?
So what you saw, so the net zero targets are a bit complicated in a sense that there is different timelines. So New Zealand net zero target is 2050, but a lot of organizations around New Zealand have aligned, and a lot of regional councils actually set themselves at 2030 targets net zero. And because they can be achieved through offset, a lot of organizations just go off by offset and achieve them on day one. So a little bit like what I showed you for the Nelson Airport. So that's how they show alignment with the net zero. You saw what Wellington has done. Again, they have a target of achieving it by 2030, and there was they're achieving it through purchasing the renewable energy certificates.
Yeah. And I think Wellington say that they'll be there sooner than expected. I think they're anticipating to be there by 2028 now on their net zero. One more question here. We've got literally probably 30 seconds, Marta. You'll see it there. So renewable energy certificates can't be used for a science-aligned 1.5 net zero target. Is that correct? And what's SBTI's position on the use of RECs in short-term targets?
So it's more about what XRB requires. So XRB requires the targets to be gross and location-based. So in order to achieve the if we're using location-based calculations, their RICs cannot be used, correct?
Great, thank you. Look, perfect timing. We're going to keep rolling on. We want to make sure we've got plenty of time to hear from Jeska, and we're going to hand it over to Jeska now, who's going to run us through what needs to be assured, who can provide assurance, and what are the auditors looking for. So over to you, Jeska, and welcome.
Thanks, Simon. Kia ora koutou, ko Jeska toko ingoa. It's lovely to be here today to speak to you all. That question, what are auditors looking for? Well, that's an absolutely huge question, a lot, because we're quite nosy. My time is limited with you today, so I thought I'd really just like to focus on a few key areas, which are up on the screen at the moment. However, I want to be helpful, so I've provided some more detailed slides to Tonkin and Taylor, and I'm going to send those out to you later. So the three areas I've chosen to talk to today or speak to you about are what needs to be assured and by whom, secondly, estimation uncertainty, and then finally, internal controls, information management, and record keeping. So first up, just let's be clear about what actually needs to be assured. As you know, the whole disclosure doesn't need to be assured, it's just the greenhouse gas information. So that's the Scope 1, Scope 2 and Scope 3 emissions. However, as you know, you can use the adoption provision, and recently that's been extended for another year. We also have to assure the description of what standards were used in the measurement, the consolidation approach, the source of emission factors, and the global warming potential rates. We also need to assure what you've excluded, including your justification for that. And we've heard in the previous discussion how important the justification is in being transparent. And lastly then, but in my view, most importantly, we assure the greenhouse gas emission methods, the assumptions, the estimation uncertainty, which I'll talk a bit more about soon. Now, in New Zealand at the moment, there's not many experienced greenhouse gas auditors, but you'll be really pleased to hear that that's rapidly changing, and some audit firms are making use of overseas expertise as well, which is great. The XRB standards, though, they allow anyone who's both competent and independent to conduct the audit. So that doesn't need to be your financial statement auditor. However, auditors, if you're environmental engineering, accounting background, finance, regardless, we all need to comply with the same standards, and that's the XRB assurance standard. Now, there's a lot to cover in an audit. Many reporters and many of you on the call today will have a long history of voluntary reporting and assurance, which is great. So you've set up well for this. In my experience, though, there's still one area that most organisations struggle with, and that's the estimation of uncertainty. So I'd like to share my views on that with you now. In the standard, it states that uncertainty needs to be described for all greenhouse gas emissions. However, it doesn't give a very useful, or doesn't give a definition of what that uncertainty actually means. My favourite definition is from the ISO greenhouse gas measurement standard, and I'll just read that out to you now. Uncertainty information typically specifies quantitative estimates of the likely dispersion of values and a qualitative description of the likely cause of the dispersion. So you can see there under ISO that uncertainty has these two elements, the quantitative part, which you're all familiar with, a number or a percentage or a score, but also the qualitative part, which is around the description. And that also includes the likely causes for the uncertainty. Just keep in mind, though, that there's actually nothing in the climate standards that state that you both have to do a quantitative and a qualitative uncertainty, though you'll see soon that it's actually good practice and really useful. The climate standards require that you describe uncertainty. And my view is that most people find it really difficult to describe something that's technical without having assessed it first. So that kind of generates this need to complete an uncertainty assessment. Now, where it gets tricky is that you actually need to communicate the outcome of the uncertainty assessment, as the standard requires you to describe the effect the uncertainties have on the greenhouse gas disclosures. This means that you need to really be able to communicate enough detail about the effects of the uncertainties for people to make decisions on the information that you're reporting. And I really see this as a prime opportunity for you to be transparent and build the trust and confidence with the reader of your disclosure. Now, also, please remember that uncertainty, or greenhouse gas uncertainty in particular, is multifaceted. And in my experience, I feel like a lot of reporters are not considering all the dimensions. Marta's mentioned this a bit earlier, but just to recap, that uncertainty can be found in the assumptions you use, if you're using average figures or industry figures, the use of default emission factors, if you've got limited data availability, your survey response rates, for example, with staff commuting, your reliance on suppliers for activity data, which may or may not be assured. And then there's also uncertainty in models, if you're using a model to calculate your emissions. Now, just keep in mind that data quality isn't static, and it's going to improve over time. There's an evolution that needs to be had, and you need to be in a position where you can deal with that evolution. I recommend that you implement a data quality framework, and it can be a really useful way to be able to handle that. One of the benefits of an uncertainty assessment is it really helps you identify the opportunities and gives you the information you need to help secure those additional resources to make the necessary improvements in the future. You might need to get more input from procurement, or you might need to get some software measurement, or there's a whole lot of additional resources that are needed for data quality, and it's time and money. Now, most importantly though, reducing uncertainty over time increases the reliability of the information, and it gives confidence to the readers of the disclosure, which I'm sure you'll all agree is absolutely critical. Your own organisation, including your directors though, will also want confidence in your reporting systems. And there's a lot of information and data that needs to be managed. Now, as auditors, we may seem hyper-focused on internal controls, information management, and record keeping, but that's for a really good reason. So I'll take that opportunity then to move on to my final point. So as auditors, we do a lot of inquiry around the internal controls and quality assurance processes that you have in place. We want to know that you have processes in place to ensure the completeness, integrity, and accuracy of the information, and that those processes are effective. We like to see that you've got systems in place to pick up the errors and consistencies regularly and allow consistent measurement and reporting every year. My recommendation for you is to always consider how your greenhouse gas reporting can be incorporated into your existing controls. Now, just a quick example there. If your data is coming from supplier invoices, is there the opportunity to train your accounts payable team so that they're checking more than just the correct dollar value on the invoice before it's paid each month? It's really, really important that you do allow staff enough time to collect data and start looking at data collection systems well in advance for Scope 3 emissions. I know you've all got an extension, but make sure that you're well underway now. Now, suppliers might need then some extra motivation or a bit of a push to send you the data that you need, and actually in the format that you require it. And that's really important, that it's in the right format. So it's likely that you're going to have to work closely with procurement and legal and get their support to add in data requirements into contracts and supply agreements. I'd like you to think about as well also how you can automate data collection and reduce the instance of human errors. I know most of you on the call, you mentioned that you are writing these reports, so you'll be well aware that the Financial Markets Authority has published record keeping guidance. Now, if your existing information management systems and record keeping policies don't cover greenhouse gas information, then you're really going to have to consider how you're actually going to go about and implement these FMA requirements. It's really, I guess, common at the moment, because some of this is quite new for businesses, that I see these mature financial health and safety and quality reporting systems, and they have really clear information management and requirements. They have clear record keeping policies, but then the greenhouse gas information is just kind of sitting out here in its own silo. It's been viewed as a project. It's not yet business as usual. And the consequence of that is that it means that that information isn't subject to the same controls or protection, and that's a big risk for your business, and also not in line with the FMA record keeping guidance. Now, I've covered quite a lot today. I feel like the most value for you will be in the questions that you get to ask me, but just to recap, my key points have been that assurance is required for the Scope 1, 2 and 3 emissions, including methodology assumptions, uncertainty, consolidation approach, emission factors, and your justification for excluded information. Any competent and independent auditor can conduct assurance as long as they're following their XRB assurance standard. It's really important that you consider how you're going to communicate uncertainty effectively to the readers of your disclosure, so that they can have the confidence to make the decisions that they need to. Please invest time to develop effective internal controls and implement the FMA record keeping guidance. And just remember, it's early years. For a lot of you, this is new. It's not about perfection, but it's more important that you create this environment that supports continuous improvement and an evolution of data quality over time. So thanks everyone for listening. I'm happy to answer any questions you may have shortly, but in the meantime, I'll hand it back to Simon.
Thank you, Jeska. That's awesome. Really good. And I loved, you gave us a couple of really good examples there. And I think we're probably all aware that the Scope 3 challenge for organisations to get enough confidence in the data has been a real challenge, and we saw that in the submissions back to XRB. I just wonder, though, I know you're not allowed to talk about specific examples, but in terms of sort of tips that you offer. So, for example, you talked a little bit about accuracy of staff commuting data, and you talked about the potential to train some of your team members to do more while they're going through current systems and processes. I just wonder if you've got any other little examples like that, practical ways that people might be able to address some of those issues, particularly with the Scope 3 challenge.
Yeah, the Scope 3 challenge is massive, but I think you need to get started. And I think just looking at some of the councils, they're a great example of the evolution that happens over 5 years. The first year they might send out an email to their main contractors wanting information, and they'll get some bits and pieces back in an email, a few numbers. The next year they send out a more extensive survey and actually say, right, we need it in this format. Not everyone responds, and then it gets put as contract requirements. We require this now at this time in this format, and you need to complete this. And I think that's the challenge of the Scope 3 is, in a case of a council, they might have 20 main contractors providing data, but in other situations, you could have hundreds or thousands of pieces of information coming. So it becomes around, I guess, the information technology and systems needed to collect that, and that often takes time and money as well. I guess always look for data that can, in your Scope 3, that can be pre-verified. So I encourage people to push that out, that requirement out. And that's just not for me trying to, help auditors, but just go back to people and say, what's the quality of this data? It doesn't mean that some data has to be independently verified, but who's checked it, how can you have, ask them the question, how can we have confidence that this is correct? What do you have to support it?
Thank you. Awesome. And then we've got a question here from John Cray. John, do you want to ask your question? If you can unmute yourself.
Yeah, I understand for the bigger companies, they might put into their contracts, but when you're looking at smaller organisations, and especially using a supply base, what's the legal basis that you say that you've got to supply this information?
Good question. I guess it depends on your contract you have with suppliers, because in some cases there might be no legal requirement for them to provide information, but I find that a lot of smaller suppliers are really reliant on, these big clients, and it's a relationship and a work in progress, and the corporates can really help these smaller suppliers provide the information that's required, but also think about, is it actually material for the inventory? Don't go and chase rats and mice. If the tiny suppliers aren't important to your inventory, then the data quality is actually less important. So keep that in mind as well. And as Marta's already pointed out, you can exclude emissions with justification, and sometimes people might have gone and got a response from 80% of their suppliers and use that to kind of pro rata to 100 and estimate 100%.
Cool, thanks.
Thank you, Jeska. So we got any other questions, either for Jeska or if anybody's got any other questions that we want to post to Marta or James? We've got another 2 or 3 minutes, so we can just pick up any other questions if people have got them. And if you don't want to spend the time typing it out, maybe you can put your hand up, your virtual hand, and we'll come to you and ask you to ask the question. And if not, it must mean that our presenters have done a fantastic job covering all of the issues that you wanted to know about. We will be sending out the slides, Jeska's slides, and I think there'll be a few gifts in there which have got much more detailed notes on them, particularly from Jeska. So those will come out, as will the recording. So we haven't got any hands going up. I think maybe
there is one more, that Simon from Waymond.
Fantastic.
At the bottom.
Waymond. Any examples of quality uncertainty disclosures, especially ones that give a quantitative assessment?
I'm really sad to report, Wyman, that I can't give you an example of a perfect one, or one, I think there's people that have done a really good job because there's a percentage with the emission factors. That's something that people can get their head around. Sometimes people have gone to the trouble, with fuel. Some people just assume that fuel, from your fuel card is correct. But if you go back, those fuel pumps are calibrated and there's uncertainty in those. So I've seen people go, and find, if you go to places like SGS, they'll tell you what's the average uncertainty in meters, or scales for weigh bridges and landfill. Yeah, sorry about that. But there is the Clean Energy Regulator in Australia, the Australian government. So they've had the ENGAS reporting for a long time. They provide a Excel tool and some guidance around quantitative uncertainty, but it's only for scope 1 and 2 emissions, which, to be honest, is the easy part. So it's a work in progress. In my slides, I've just put a note that I think it's next year, ISO 14064 gets published, and that's the updated and renumbered standard for guidance on the implementation of ISO 14064 Part 1, and that includes more guidance on uncertainty assessment and gives a formula to how to calculate uncertainty as well.
Brilliant. Thank you, Jeska. Awesome. So while we've got you here, what we would like to do is just know if there's other information that you might want a more detailed session on. And we've got a couple of poll questions that will go into the chat now that we'll find out if you're interested, and if so, what sort of thing might be more useful. So it's useful for us to know if we're going to do another webinar where we can get a deeper dive that is going to be most useful for you. So you'll see there we've got 2 poll questions. One, are you interested? And second one is, what are you interested in? So that will really help us and deliver some content that's more tuned to your needs in the future. So just click on your buttons and we'll see, yeah, people like examples, that's for sure.
Well, Simon, anything that's not on the list, feel free to put it in the
put it in the
chat.
chat. Absolutely. Yep. Please, if there's something there that you want to cover that we haven't mentioned, and please put that in the chat. And if others like that suggestion as well, then give it a thumbs up and that will give us an indication. But certainly practical examples, deeper dive into the disclosure requirements. Generally, I mean, there's so much to cover in the session today. I think you guys have done such a wonderful job to provide as much detail as you have. It's such a big field. But yes, looks like there's some people interested, and practical examples, more details about the risk exposure quantification, second place, and the deeper dive on the CRD disclosure requirements generally. It's really helpful. Please do continue to put anything else in the chat. Multiple options. Look, tell us, Josh, what you want. Just put it into the chat if the question wasn't quite able to allow you to express everything you wanted to.
You can vote twice.
And you can vote twice. Brilliant. Look, thank you. Let's just close things off with a karakia. Thank you very much indeed to our presenters. What a fantastic session. Ki tōna manakitanga a te mea nui. Ki runga, ki raro, ki roto, ki wahu. Kia tutu ngā mahi katoa. Homye, huye, tai kie. Thank you, everybody. Thank you. Big thank you to our presenters. Jeska, thank you. Marta, James, thank you. And thanks to all of you guys for joining us. That's what makes it a special occasion. And keep in touch if there's anything else you want. We'll be sending the slides out and the recording. And big thank you to Katie and to Molly for all of your support behind the scenes, running the polls, helping get the slides ready and all of that. It's a great team effort. So many thanks. Kia ora. Have a great weekend.
Thank you, everybody.